Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about FLOWSERVE CORP quarterly report. FLOWSERVE Corporation offers a diverse range of businesses and services across various industries. Some of the key areas include industrial flow management equipment, custom, engineered pumps, preconfigured industrial pumps, pump systems, mechanical seals, auxiliary systems, replacement parts, aftermarket services, equipment installation and commissioning services, seal system, spare parts and repairs, advanced diagnostics, and re-rate solutions, isolation valves, control valves and valve automation products, actuators, positioners, and switches for flow control systems, equipment maintenance, services for flow control systems. The company serves various industries including oil and gas, power generation, chemical, water management, mining, food and beverage, steel and pulp and paper. FLOWSERVE Corp stock price has increased by over 25% in the past year due to several key events. The most significant contributor was the divestiture of asbestos liabilities and a major contract win on October 29, 2025, which drove a 25.96% surge in the stock price. Additionally, strong third-quarter earnings in 2025, with adjusted EPS of $0.90 surpassing analyst expectations, led to a 3.5% increase in shares. The proposed merger with Chart Industries in June 2025 also had a positive impact on the stock, although it was later terminated. Furthermore, FLOWSERVE's acquisition of MOGAS in October 2024 augmented its product portfolio and accelerated revenue growth synergies. These events have collectively contributed to the company's improved financial performance and increased investor confidence, driving up the stock price over the past year. The primary drivers of revenue growth and decline can be identified from the financial summary provided. Revenue growth is primarily driven by a 6% increase in net sales, with original equipment revenue showing mixed results across different product lines. The aftermarket segment experienced significant growth, particularly in FCD, while intersegment sales and bookings also increased. On the other hand, revenue decline was mainly attributed to acquisitions and divestitures, which resulted in losses of $0.02 billion in 2025 and $0.01 billion in 2024. Additionally, Precision Flow Systems experienced a 2% decline in 2025 compared to 2024. Decreased earnings from affiliates due to the FPD joint venture's decreased earnings in South Korea also contributed to revenue decline. Overall, these factors highlight the key drivers of revenue growth and decline, providing insights into the company's performance and areas for improvement. The net income of a company underwent significant fluctuations over the given period. Initially, it increased from $58,382 to $219,582, and then further rose to $375,241. However, there was a notable decrease of $1.1 million in the 3 months ended September 30, 2025, due to decreased earnings from the FPD joint venture in South Korea. Conversely, net income increased by $1.3 million for the 9 months ended September 30, 2025, thanks to higher earnings from the same joint venture in India. Profit margins also experienced changes during this period. The gross profit margin improved from 31.4% to 32.3%, but later decreased to 28.9% for the 9 months ended September 30, 2025. Operating income showed a mixed trend, decreasing initially and then increasing by $25.6 million and $83 million for the 3 and 9 months ended September 30, 2025, respectively. The variations in net income and profit margins can be attributed to changes in earnings from joint ventures, particularly in South Korea and India. These fluctuations highlight the importance of monitoring and adapting to shifts in market conditions and performance metrics. The company's financial performance indicates a positive trend in operating cash flow. The data from various pages of the summary confirms this, with net cash flows provided by operating activities increasing to $506,058 in 2025 compared to $227,960 in 2024. This significant increase suggests that the company is generating sufficient cash from its operations to cover its expenses and invest in growth opportunities, indicating a positive operating cash flow. The company's debt level and interest expenses have undergone significant changes over the past year. In terms of debt level, the long-term debt due after 1 year decreased from $1,460,000 $1,132 in 2024 to $1,435,568 in 2025. This reduction is a positive sign for the company's financial health. Additionally, the available capacity on the second amended and restated credit agreement increased to $715.4 million as of September 30, 2025. However, interest expenses have seen a significant increase. Net interest expenses rose from -$15,184 in 2023 to -$17,946 in 2024, and further increased to -$18,738,000 for the 3 months ended September 30, 2025. This increase in interest expenses is a concern for the company's financial stability. The cash flows used by financing activities also saw a significant jump from $107.4 million to $330.9 million between 2024 and 2025. This indicates that the company has been using more funds for debt repayment, which may be contributing to the increase in interest expenses. The financial performance of FLOWSERVE's financial performance was mixed across its segments. The FPD, FLOWSERVE Pumps Division segment, struggled with poor performance and higher restructuring charges, indicating a need for improvement. In contrast, the SG&A segment showed resilience with lower restructuring charges compared to the cost segment. The FCD segment demonstrated stability, while the FPD segment showed some signs of recovery, with increased bookings and sales. However, its gross profit margin and segment operating income also rose, suggesting that the division still has room for improvement. Unfortunately, there is no information available on the performance of FLOWSERVE's regional operations. Management's outlook and strategy overview. The company's management continues to monitor global events, such as the Russia-Ukraine situation, but does not expect a significant impact on its business. The primary concern is managing credit losses, with an estimated 1% allowance for accounts receivables and contract assets. To achieve growth, the company will focus on its 3D strategy of diversification, decarbonization, and digitization. This strategy aims to deliver sustainable growth while improving operational efficiency. Management also plans to invest in capital expenditures, totaling $75 million in 2025, to support strategic initiatives and cost reduction. In addition, management is focused on managing working capital, reducing cash flow usage from accounts receivable, inventories, and accounts payable. The company expects to continue returning cash through dividends and share repurchases for the foreseeable future. Overall, management's strategy prioritizes growth, operational efficiency, and financial stability. The company has made strategic moves to expand its portfolio through acquisitions and divestitures. Notably, it acquired MOGAS, a significant addition to its business. On the other hand, it divested NAFOB for $2.6 million in cash, and also sold asbestos-related assets and liabilities through the sale of BW/IP New Mexico, Inc. These transactions demonstrate the company's efforts to optimize its operations and resources. The company's financial summary reveals that it has demonstrated a commitment to returning value to its shareholders. Notably, the company has paid dividends, indicating a distribution of profits to investors. Additionally, it has also engaged in share buybacks, which is a strategic move to reduce the number of outstanding shares and potentially boost earnings per share. Supply chain concerns loom large for companies. The current business landscape is fraught with potential supply chain disruptions. The ongoing Russia-Ukraine conflict, higher import tariffs, and geopolitical tensions all pose significant risks to global supply chains. These factors could lead to inflationary pressures, recessionary conditions, and increased costs for manufacturers. Furthermore, the current inflationary environment may also hinder the efficiency of manufacturing processes, ultimately affecting customer satisfaction. That concludes the financial summary for FLOWSERVE CORP. Feel free to comment below, and I will be happy to answer them when possible.